evening, everyone, and welcome to this study circle meeting. On behalf of Baikal CP Study Circle, I welcome you all on this meeting on tax audit, clause-wise analysis. We have very fortunate to have a very senior chartered accountant with us. And for his introduction, I would like to request our past convener, CA Tasneem Dalal, to give a well-deserved introduction.
Good afternoon, everyone. Yeah. Ashok ji, good afternoon. We are very happy to have you with us.
Good afternoon.
And thank you so much for joining us in this webinar. And we are really fortunate that you have come as a learned speaker, to tell this. To all my other friends, the date of birth is 15th May 1952. Sir has done BSc, he is an FCA, he is DSA qualified, and the name of the firm is Saith and Associates, which is founded in 1975. He is a fellow member of the Institute of Chartered Accountants of India with a postgraduate qualification in Information Systems Audit from, again, the Institute in July 2002. And he got 35th position in merit on all India basis in CA inter-examination. He's been in practice since 1975 in income tax and audit sites. He's also been chairman of Lucknow branch of Institute of Chartered Accountants of India, 85, 86, 94, and 95. Member of the managing committee for 18 years, organized various seminars and 2 regional conferences, etc. Technical contribution, he has presented papers on subjects of auditing, income tax, company law, and information technology in various workshops, seminars, and regional conferences. Plus, he has been member committee of information technology, the Institute of Chartered Accountants from 2007 to 2008. He is member of Regional Information Technology and Web Designing Committee of Central India Regional Council for 2002-2003. He is member of Corporate Law Committee of the Institute of Chartered Accountants of India, 97-98. He is member committee for Review of Education and Training, the Institute of Chartered Accountants of India for 95-96. He has given various lectures in direct taxes, Regional Training Institute, Lucknow on different topics. He gave a talk on personal taxation at IIM Lucknow and NDP program on 17 September 2002. Then he's presented paper on VAT concepts and its variants at a national seminar on value-added tax issues and implications on 20th April 2003, organized by the Commerce Department of Lucknow University. He is a member of the Kanpur Study Circle on Companies Amendment Bill. He's been the chairman of UP Task Force of Professional Development Committee of the Institute of Chartered Accountants of India, 1988-99. He is member of Professional Initiative Group for the state of UP of the Institute of Chartered Accountants for India, 2001-2002. Member of Study Group for Preparation of Guidance Note on Audit of Consolidated Financial Statements of the Institute of Chartered Accountants of India. Thank you very much once again, sir. And we are most honored to have you, and we welcome you. Thank you.
My pleasure.
Thank you.
My pleasure.
Sir, may I request you, Murtaza bhai, if I don't know how many members, do you want to wait or shall we start?
Your choice. I can wait for 5 minutes more, no problem. If you expect more members.
Okay.
We just wait for 2 minutes and then start. Yeah.
Sure, no problem, no issue. At least on webinars, we have started starting on time. That is the one good thing which has happened.
Correct. That is true. That is true.
Just before we start, we request all the participants to keep themselves on mute and also to rename themselves with their membership number in the name so that we can mark the attendance. I think so. Let's start, sir. We can start.
Yeah, yes, please start. Let's start.
Good evening, conveners and deputy convener of the Bipolar Study Circle and all the members who are present today in the study circle meeting for discussing the 3CD. This is because of the technology that we are, I am rather, addressing members as far as Bipolar in Mumbai. I could not have imagined about 10 months back that I would be addressing members as far as Bombay, though I have addressed in Bihar and Madhya Pradesh and Rajasthan, but not as far as Baikula or this was saying. But still, this is the one thing which has nicely happened. And second good thing which has happened is collecting members on time for seminars. I have seen even regional conferences starting 2 hours late. But now the members have started attending the webinars on time. That is something very good. Dear members, I have to discuss the 3CD with relation to the various clauses, especially the amendments also in the 3 clauses which took place on 1st October 2020. Before I start on clause by clause discussion on the 3CD, I would like to share certain general issues or concerns which I feel it is very important as far as tax audits are concerned. The first issue which I think was communication with the previous auditor. This is very, very important, my dears. Communication with the previous auditor is required professionally under the code of ethics of our institute. But I have seen in certain cases, or rather in many cases, that members do not correspond with the others while changeover of the auditor takes place as far as even for tax audit report, which is mandatory. So please don't take it lightly and do communicate with the member about the change if you are the appointed auditor, or if you are the outgoing auditor, they will then respond to the communication which you receive from the other members. Secondly, management representation letter is a very, very important tool or rather requirement for the tax audits. In various clauses of tax audit, you cannot give your opinion without taking a management representation letter. For example, 14A, the calculation has to be done by the management and then it has to be incorporated in your report. Demands created, there is a clause of demand created under various laws. In which laws the demand has been created by on the client has to be informed by them only through a letter. Then there is a clause for informing the audits done under various acts. So all these things cannot be replied, and many others also cannot be replied without taking the management representation letter. So this letter is also as important for the tax audit as is important for otherwise. Then applicability of accounting standards. Accounting standards are all applicable on tax audits also. They are not only for the company's audits, they are applicable on tax audit also. Because in 3CB, We are certifying the true and fairness of the accounts which are enclosed with our report. So I have, with my experience, seen many tax audit reports of various members not having the accounting policies, something very, very elementary, but not having the accounting policy along with the tax audit report, the final accounts. Then accounting standard 2, implementation of accounting standard 2 for valuation of the stocks. Members right valuation has been done according on the cost or net realizable value, whichever is lower, without even mentioning how the cost has been worked out. Is it on the FIFO method or is it on the weighted average method? But it is kept silent. Then AS5, prior year expenses. AS16, the issue of interest capitalization and otherwise treating the interest in the final accounts. AS22, that is the accounting standard on taxation. In many cases, on account of disallowances in 43B, on account of losses carry forward, on account of carry forward of depreciation, the deferred tax comes into picture. So if it is a material amount of deferred tax, and if we don't provide deferred tax in the final accounts, then how we are certifying that the final accounts which we are certifying as a true and fair are true and fair? They are not, unless all the taxes are provided for. I have, in my experience, seen many balance sheets in which even tax provisions have not been made in the profit and loss account, and the profit and loss has been certified to be true and fair. How any profit or loss or anything can be true and fair without the implication of taxation in it? So you have to make a provision for taxation, and then only you can say the accounts which you are certifying are true and fair. So basically, my emphasis was that the accounting standards are very, very important for implementing in the tax audits also of proprietary concern, partnership firms, LLPs, everywhere, not only in companies. Companies there are, no doubt about it. There we have to specifically certify in company's report that the accounting standards have been followed. But as far as firms and individuals are concerned, when we are certifying 3CB and attaching the certifying the true and fairness of the financial statements, we have to see that the accounting standards are complied with. Previous year figures in many cases of partnership firms and individuals' balance sheets are not given. This is absolutely wrong. AS1 itself says that the previous year figure should be given along with the current year figures. And if you are not giving previous year figure, how you can say that your accounts are true and fair? So these are a few very, very basic issues regarding accounting standards, which I gave by example only. But we have to mind that all the accounting standards have to be followed. Then materiality. Materiality is also as important a concept for tax audits as otherwise. I love again sharing my experience. I have seen balance sheets and profit and loss account saying 100 rupees as prior year expenses, 50 rupees as a prior year expenses. Now, what is prior year expenses, that we will discuss slightly later, but then we have to see the materiality of the amount in relation to the overall size of the financial statement, and then give a qualification or do the presentation of the final accounts. So, which sometimes we ignore and say that tax audit is there, so it has to be correct. It has to be correct by Anna and Pi. No, it is not. Materiality is as important aspect as far as the financial accounts are concerned. Then auditing standards. Auditing standards are also all applicable for the tax audits as well. And we have to mind that we should follow the account auditing standards, especially the sampling methods of auditing and everything. So auditing standard has also to be followed. So these, I think, were the general issues which I wanted to discuss before I start on the clause by clause issues. Then the first thing comes whether we have to apply 3CA, whether we have to give report in 3CA or 3CB. Proviso 3 of 44AB provides that when a person carrying on business or profession is already mandated to get his accounts audited under any other law, then he will furnish a report under that law and a report in prescribed Form 3CA. Meaning thereby, if the accounts of the SSE are required to be audited under any other law, then we are required to submit the report under that law and a report in Form 3CA along with Form 3CD. Otherwise, we have to file report in Form 3CB and along with the 3CD. Now, one thing is there, as far as companies are concerned, we all know that in Companies Act, we have to certify separately for auditing of the companies. So we issue 3CA. We issue 3CA plus 3CD. Now, in case of LLP, the LLP Act Section 34(4) provides that the accounts are to be audited in accordance with rules. And Rule 24 prescribes that if turnover is more than 40 lakh or contribution is more than 25 lakh, then auditing is required. So in my opinion, if these two conditions are applicable in the case of LLP, that is turnover is more than 40 or contribution more than 25 lakh, then we have to issue audit report compulsorily under the LLP Act, and hence we should issue 3CA in such cases of LLP instead of 3CB. Now, 3CB requires assurance whether financial statements are true and fair, and that particulars in Form 3CD are true and correct. So we have to certify both things. We have to even certify the true and fairness of the accounts which we are signing, and also that Form 3CD particulars are true and correct. Now, Para 3A of 3CB says, we report the following observations, comments, discrepancies, inconsistencies, if any. And Para 3B also contained in Para 5. In our opinion, and best to the above information and according to the explanation given to us, the particulars given in the SAT form number 3CD are true and correct, subject to the following observations, qualifications, if any. So, mind it, there are two places in the form 3CB or 3C in 3CB to qualify, to give the qualifications or observations, that is Para 3 and Para 5. Now, Para 3 is regarding true and fairness, and Para 5 is regarding the true and correctness of Form 3CD. So, any observations or qualifications regarding true and fairness of the account should be given in Para 3A and not in Para 5. And in Para 5, those observations and qualifications should be mentioned which are in relation to Form 3CD. That is the true and correctness of Form 3CD. If we have to make any qualifications or observations, then that should be mentioned in Para 5 and not in Para 3. And in Para 3, we should mention the observations and qualifications with regard to true and fairness of the accounts. So this differentiation has to be done. And mind it, there is no limit of number of observations and qualifications which can be given in either Form 3A, in Para 3A or in Para 5, both ways, both places. While e-filing the tax audit report, you can add numbers of lines. Now you can just go on adding plus, 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 and go on adding the observations you have. Generally, I think minimum comes around 10 observations are always there, because a lot of places we have to give our limitations of auditing also, and many places. So these Para 5 and Para 3 observations are very, very important for the tax audits. Now we come to clauses. Part A. Part A, Clause 1 is the name of the SSE. Now here I want to be slightly issue of discussion. Sometimes people may say name of SSE is very simple thing. The name of the SSE. Yes, name of the SSE. In case the SSE is a partnership firm, LLP or a company, then there is no issue. The name of the SSE is same is as a business. In case of individual proprietor, the proprietor name is different than the name of the business. Now, in my opinion, we are auditing the business transactions of the proprietor's business, which are recorded in the books of accounts of his business. So, in my opinion, name of the SSE should be the name of the business which we are auditing and not the name of the individual himself. For clarifying, either you can say Messer so and so, XXXS bracket proprietor so and so. But your balance sheet and profit and loss account heading should be the name of the business, not the name of the proprietor. There also, while mentioning the capital, you can write in the brackets the proprietor, Mr. So and so. There is a reason behind it. One reason is I am auditing the business transactions of the SSE as maintained in the books of accounts and not his personal transactions. There might be a lots of transactions in his personal saving account which are not part of the books of accounts also, and we are not auditing it also. Secondly, I am certifying the balance sheet which include the assets and liabilities of the business. Now, if I am certifying balance sheet of Mr. A, and Mr. A is owing some properties also, and Mr. A is owing some investment in shares also, and Mr. A is having a loan against the housing property also, then without showing these things, are we showing true and fair statement of affairs of Mr. A? No, we are not. But those things can't be brought into the balance sheet also. So I think it is always better to give the name of the SSE, the name of the business which we are auditing, and not the name of the proprietor. We can mention the name of the proprietor in the brackets. That is okay, because we are auditing the books of accounts of the business maintained by the SSE, not all the transaction. And there are many clauses which will come later on, which I will discuss when we reach them. That those clauses are maybe there in the case of an individual SSE, but not being a part of the business transaction. So we might get trapped there. So name of the SSE, in my opinion, should be the name of the business of the SSE and not his personal name. Then clause 2, 3, 4, 5, 6 are normal clauses. Then clause 8 says, section under which audit has been conducted. Here we have to say under which section, 44 ABA, ABAB, C, D, E, under which subsection we have conducted the audit and mentioned it there. Then the clause 8A. This clause is the newly inserted clause which was changed from 1st October to 2020. And this clause says whether the SSE has opted for taxation under section 115BA, 115BAA, 115BAB. First thing, these sections 115BA, 115BAA, and 115BAB are applicable only in the case of companies, not in the case of LLPs, partnership, individuals. So anything other than company, you can straight away say the SSE has not opted. No, there is no reason for it. In the case of a company, you have to take a call whether you have to write yes or whether you have to write no. Now, 115BA and 115BAA and BAB are sections providing the lower rate of tax for the companies, 25%, 22%, 15%. There are three slabs, three conditions in which different slabs are there for the companies to pay income tax thereon. So this clause is having one very typical problem. This clause asks whether the SSE has opted for taxation under section so and so. Now, I am auditing the books of accounts latest by 31st December. That is the last date of at present last date for filing the tax audit report. So before that date, as an auditor, I have to take call whether the SSE has opted for taxation. Okay. We can discuss with the SSE and he says yes and no, and we can reply it accordingly whether he has opted or not opted. But the problem is different. Under these, to opt these sections, there is a form 10(1)(c) which has to be filled up. And the SSE can take this option up to the last date of the filing of return under 139(1). This means now in this year at least, the return filing due date under 139(1) is 31st January. So the SSE can opt for this section up to 31st January. But we have to report it before 1 month, that is latest by 31st December. So if we say the SSE has not opted and written no, later on SSE can change its own instance and opt for these sections. So we will have to give observations in para 5 of the tax audit report for surely. This option, which has been informed by the SSE, was as on date of this report, and the SSE has the right to change this option up to the last date notified for 139(1). So that kind of observation has to be given. So there can be lots of situations when an auditor and tax consultant are different. If an auditor has discussed certain things with the client and client says, okay, I am not going to opt it, and the auditor wrote no, but later on when he goes to his tax consultant can say, no, it might be better for you to opt it, and he may opt it. And he has time also to opt it. He can opt it up to 31st January this year, because the date notified 139(1) is 31st January. So this problem is there on this section. So we have to be very careful in giving yes or no, and also to give an observation in para 5 regarding this. Then clause 4. Whether the SSE is liable to pay indirect tax like excise duty, service tax, sales tax, custom duty, GST, etc., and report for all branches if separate. If SSE is having 3 branches in different states having 3 GSTN numbers, then the information should be given of all GST numbers or any other numbers like VAT number is not applicable now, sales tax is not applicable now, service tax is not applicable now. Generally, the applicability will be customs and GST for reporting it. Then there are certain issues in this reporting also. If applicable, suppose GST is applicable on him and he had not registered, even then some disclosure will be required. Okay, the requirement is whether the SSE is liable to pay indirect tax, so liable to pay. Not necessarily he has paid or not, whether he is liable to pay. If he is liable to pay GST and not registered, then we will have to give a comment on this. Okay, yes, he is liable to pay GST, but he has not registered with appropriate disclosure for the reasons. There can be a situation where registration has been taken place, but he is not liable to pay. By abundant precaution, the SSE may have taken the registration under GST, but he is not liable to pay. So even then, a disclosure might be required in this case. Then we come to clause 11, which says whether the books of accounts are prescribed under section 44AA. If yes, list of books so prescribed. Now 44AA has prescribed the books of accounts in respect of certain specified professionals in the Act. 44AA describes certain professionals like doctors, architects, engineers and all. And as few professionals have been notified separately also. So in those cases, the books of accounts have been prescribed. And if the SSC falls in the section of 44AA, then list of books so prescribed has to be mentioned in this clause. Then it asks books of accounts maintained and the address at which the books of accounts are kept. Now, what is meant by kept is very, very dicey. The books may be maintained in the shop, but may be kept in the residence. Books may be maintained on the cloud. Now, lots of SSCs are having the books on the cloud. So, what address can be given? The books of account maintain an address at which the books of accounts are kept. I think if the address is there, then the link of the place where the data is being stored on the cloud may have to be given. Then list of books of accounts and nature of relevant documents. List of books of accounts and nature of relevant documents examined. Now, this is asking us to specify what are the books of accounts which we have examined. If we have not examined certain books of account, we may not give it. But whether without examining certain portion of books of account, can we say it is true and fair? No. But still, the books of account to be given listing is required for the documents and books examined by us. Document doesn't mean that we list out each and every document in this. Generally, we can write purchase vouchers, sales vouchers, vouchers. If there are certain other type nature of combined vouchers, then we can mention those, or correspondences. If some important correspondences are there, then those documents we can say, yes, those we have examined. Then clause 13, which requires method of accounting employed in cash or mercantile. Now it asks whether the accounting is cash accounting or mercantile accounting. This is simple because mixed accounting is no more there. So either it will be cash or it will be mercantile, and we have to mention the accounting is cash or mercantile. Now then B and C ask us whether there has been any change in the method of accounting employed. If yes, detail of change and effect on P&L. Whether there has been change in the method of accounting. Now, method of accounting employed change is with respect to cash or mercantile. In this clause, in clause 13, B and C, if there is a change between from cash to mercantile or mercantile to cash, then we have to give it in B and C. Okay, there is a change in the method of accounting. See, change in the accounting policy is not change in the method of accounting. Change in accounting policy is something different than the method of accounting. And this is what has been prescribed by the institute also in its guidance note. If there is a change in accounting policy, like say method of valuation of a stock has been changed from FIFO to weighted average, then it may not have to be reported under clause 13, but it has to be reported in otherwise in the final account. That final account are there because of this change in the method of in accounting policy for method of valuation from the FIFO to weighted average, or weighted average to FIFO, whatever the case may be, or whatever other change may be there in the accounting policy. Then those accounting policy changes have to be informed before certifying true and fairness of the financial accounts. But in clause 13, be minded, the change has to be given only if the change is between the cash or mercantile. That is, if cash system has been there, which has been changed to mercantile, then we have to report it. Or if mercantile system has been there, which we have changed to cash, then also it has to be reported here, not otherwise. Then clause D, E, and F, which requires whether any adjustment is required to be made to the profits or loss for complying with the provisions of ICDS notified under section 145(2). Now, all of you know that 10 ICDS have been notified by the government under section 145(2). Though, I may put in caveat here, many high courts have held many of these ICDS as ultra-virus. They say that the ICDS, particular ICDS, being a delegated registration, cannot override the act, cannot go beyond the act, being a delegated registration. And many of the high courts have held many of these ICDS as ultra-virus, but still we are reporting to avoid the disputes with the government. Now, it says whether any adjustment is required to be made. Now, mind it, there is a specifics in ICDS that the books of accounts may not be maintained according to ICDS. The books of accounts are required to be maintained as per the accounting standards. But the computation of income has to be made as per the ICDS. So if there is a change in the provisions of ICDS and what the books of account profit are showing, say for depreciation, in the books of accounts of a company, I may be charging them, or rather, I have to charge depreciation as prescribed in the Companies Act schedule, and not according to the depreciation rate as prescribed in the Income Tax Act. So there is bound to be a difference between the depreciation charged in the books of accounts and depreciation allowable in the Income Tax Act under ICDS. Though that will have to be reported for the difference in depreciation. Whether any adjustment is required, so that the difference of depreciation becomes an adjustment which is required because of the provisions of ICDS. Then one thing which is important in F, disclosures as per ICDS has also to be given. There might not be any ICDS which may be affecting the profits or losses of the computation of income tax. However, there have to be disclosures regarding the accounting policy which these ICDS require. What can be done, that what generally I am also doing it. In accounting policy, I mention all those disclosures which are required in ICDS also. And in ICDS annexure, I mention as per accounting policy attached separately with the financial accounts. But those disclosures of ICDS are required to be reported, other than the differences between the income between the ICDS and the books of accounts. Then we come to clause 14B, that is 145A variation. Now 145A was saying, earlier, let me go slightly into history of 145A. Before GST came into picture, all of you know that there was excise duty which was leviable on manufacturing companies. The excise duty was becoming due, no, not due, sorry. The excise duty was accruing at the time the production took place. However, the same was payable only at the time of removal of the goods from the accessible godowns. So there was a gap between the period when the excise duty accrued and the period when it was payable. Now, what was happening when the goods were being manufactured, the excise duty had to be made a provision of in the books of accounts for the goods which were produced and not dispatched. The 145A was saying that you have to include amount of any tax, duty, cess or fee actually paid or incurred by cessation during the goods to the place of its location and condition as per the date of its valuation. Now, in closing stock, the excise duty which had all accrued on the production was required to be added to the closing stock. Though the same amount was required to be provided for in the profit loss account, but the stock valuation was to be increased because of 145A and otherwise also. Now, there is a very, very long discussion on the calculation method of 145A also on page 99 of the guidance note of 2014. The Institute guidance note is also having the opinion that the adjustments of 145A are profit neutral. because the amount of excise duty which you add on the closing stock, you provide it also in the books of accounts. And though that provision was subject to section 43B, but that was required to be provided also. So ultimately, in overall, all these adjustments of 145A were profit neutral. The Supreme Court also, in the case of Indo-Nippon Chemicals, 261 ITR 275 has held that the provisions of section 145A are profit neutral. Now, after the GST has come into picture, the GST is not leviable or accruing at the time of production. GST is accruing at the time of supply. So that situation of the gap is no more there. So also practically this 145A calculation will not affect into any profits changes or variations. Then clause 15 and 16, sorry, I will take water. Clause 15 and 16, first it is, 15 says, particulars of capital assets converted into stock in trade. Yes, that is, there is nothing important about it. Nothing to discuss further, not important. Important is everything, but nothing to discuss, because if any capital asset has been converted into stock in trade, then that detailed information has to be given here. Then amounts not credited to P&L account, these have to be mentioned if they have not been credited to P&L account. If they have been credited, then no issue, nothing to be reported. The item falling within the scope of section 28. There are many subsections in 28 which require that so and so amounts are the income and need to be taken to income tax account, profit and loss account, and need to pay tax on that. So all those items, if falling within the scope of section 28, have to be reported if not credited to profit loss account. Generally, there is no item in section 28 which is not required to be credited to the profit loss account. So all are credited to the profit loss account, mostly. The pro forma credits, drawbacks, etc., which are admitted by authorities. If the duty drawback or credits are admitted by authorities, then they should be part of the profit loss account also, otherwise elsewhere, as from accounting standard point of view. This section is specifically warned if duty drawbacks, etc., have been admitted by the authorities and have not been credited to the profit and loss account, then it has to be reported here. Mind it, in management representation letter, this is one thing which is to be taken from management. How much are the duty drawbacks, etc., which have been admitted by the authorities? Because this figure we can't get it from the books of accounts. So here we have to fall back on management representation letter. Then escalation claims accepted. Unless it is accepted, this means they are in disputes or something, then it may not be credited to the profit and loss account. But if they have been accepted, then definitely they have otherwise also to be credited to the profit and loss account. But in case they have not been credited to the profit and loss account, then they have to be reported. Any other item of income, if not credited to the P&L account, it has to be reported, and correctly so also. If any income is there, naturally it should be credited to the profit and loss account. But one thing last is very typical. Capital received, if any, not credited to the P&L account. Now, if it is a capital receipt, how it can be credited to the P&L account? P&L account is not for the capital receipt. It is for the revenue receipts. But they ask capital receipt, if any, not credited to the profit and loss account, have to be mentioned here. Then clause 17. Whether any land or building or both is transferred during the previous year for a consideration less than value adopted or assessed or accessible by any authority of a state government referred to in section 43CA or section 50C. whether any land or building or both is transferred during the previous year for a consideration less than the value. Now, first is adopted, okay, that if your deed is executed, then you can take the value from the sale deed, or assessed. If it has been assessed by the stamp duty officer, then also you can take it, or accessible. Now, if deed has not been registered, then it becomes accessible. Then how to calculate the value of this accessible by authority of state government is something very dicey. And whatever method has been adopted to work out this accessible amount, if it is there, then observation is required in para 5 of 3CB, that this is the method by which the accessible value has been worked out. In case the deed has been registered, then there is no issue, then there is no problem. You can simply see the deed and see what is the value given in the deed on which stamp duty has been paid, and that becomes the value. But if otherwise not assessed, then it has to be estimated by accessible. And how much is accessible? It has to be seen. Now, this is also the one of the reason for the I am saying clause. When I said that the name of the assessee should be the business of the individual and not the proprietorship name. Because if you are auditing the business of the assessee and he is selling, say, his personal property, his residence, then it will not be covered in this clause, because you are reporting on the business transactions as per the books of accounts and not the individual transactions of the proprietor. If there is an unregistered document, then the value as accessible will have to be worked out, and whatever way that accessible value is worked out, in my opinion, should be clarified in the observations of para 5 of the 3CB. In individual, capital assets forming, not forming parts of account, and that was a thing which I have discussed. Capital assets of personal assets are not forming part of the professional business books of account, and so not have to be reported. Now, in 50C, 43CA, and such sections, there have been lots and lots of dispute, and there are numbers of cases also on various issues. So, when there is a difference of opinion regarding transfer, whether transfer has taken place or not, transfer has not taken place, and things like that, then the auditor's duty on difference of opinion should be specifically clarified in para 5 of the observation sheet. It is very, very important. There might be many situations in which there might be dispute regarding even transfer, whether the transfer has taken place or not. Then land and building forming part of the block. If the block is still positive, section 50 is not applicable, but there are certain court decisions which are favorable, certain court decisions which are against, and the auditor has to take a stand on the basis of one of the decisions, but whatever decision he takes has to be, or should be rather, reported through the observation sheet in the clause 5 of 3CD. Then clause 18 of depreciation. It looks very simple, but it is not as simple. There can be dispute in depreciation rates. For example, there may be a mobile phone costing 60,000, 70,000. Now, there can be dispute whether this mobile phone is a computer chargeable to depreciation of 30%, 40%, or it is an office equipment at 15%. I may say that this definition of computer is what? A computer is something which processes data. Now, a mobile phone costing 60,000 processes all data, just like any computer. And so why it is not a computer? So there might be lots of places where there are difference of opinions, and there can be a asset which can lie in two different areas with equal conviction. Then also we have to fall back on observations regarding the dispute and depreciation rate of various situations. Then issues in additional depreciation are there. Till last year, the additional depreciation dispute was too much that if a plant and machinery was added in the second half, then how the balance 10% will be available in the next quarter, next year or not, and things like that. So any issues in additional depreciation also have to be addressed through observation clause. Disallowances in past by AO. Now, if there was, say, suppose a scrutiny case 2 years back or in 3 years back, and in the scrutiny case, I charged the depreciation at certain rate and AO allowed it a certain rate, and there is a variation in the closing balance of WDV. Now, there can be two situations. If we have accepted the order of the AO and not gone into appeals and things like that, then the WDV has to be reworked on the basis of the assessment order of the past years, making additions in the future years and things like that. And that should become the opening WDV. Now, there is a simple situation. The second situation is the differences made in depreciation by the AO in the assessment are under appeal, and the appeals are pending. Then what I have to do? Whether I should take WDV as per my own calculations of the tax records, or whether WDV as per the AO's calculation in the past years when he disallowed certain portion of depreciation. Whatever stance we take, depending on the quantum of appeal, depending upon how far we are sure regarding the winning the appeal and all, we have to take an stance whether we are going to follow the WDV of our own tax records or the income tax records. But we should give an observation in para 5 of the 3CD that this is the dispute regarding WDV of particular asset. And this is the reason that I have taken this following instances of claiming WDV as opening balance. Then subsidy under section 43(1) or 224(13) has to be reported. Unabsorbed depreciation section 32(2). That is a one area which slightly gives accounting degree. Section 32(2) says any unabsorbed depreciation would become depreciation for the year. If that is so, then how the depreciation schedule can be made? So what we do, we take up the depreciation as per carry forward depreciation through the losses statement, differentiating there the unabsorbed losses and unabsorbed depreciation. Though the unabsorbed losses lapse after a certain period, the unabsorbed depreciation doesn't lapse. So we take the unabsorbed depreciation through those annexures only, and not through the depreciation allowable at as per the Income Tax Act. Then new areas have been added, 18CA and 18CB. Now, if the SSE is opting for 115BA, 115BAA, or 115BAB, then there are certain conditions. And one of the conditions is that if any unabsorbed, if any WDV which is being carried forward includes the unabsorbed additional depreciation, then that additional depreciation will not be allowed to be carried forward in the current year in which you are opting for 115BA, BAA, or BAB. And similarly, certain other things which are not allowed to be carried forward under these three sections have to be mentioned in this depreciation schedule. So 18CA and 18CB require us to inform the figures of such depreciation which has to lapse on account of option of 115BA or BAA, BAB being taken over by the SSE. If SSE is opting for these things, then if he is having depreciation which has to be disallowed, then that has to be calculated and adjusted in the depreciation schedule. If he is not opting for these three sections, then this will become zero. Then clause 19. it says amount admissible under section so and so, so and so, so and so, so and so. I'm not going into the each and every section. But if I am claiming any expenses under these sections like scientific research and lots of many promotional type of deductions are there allowable. So if I am claiming such thing, then we have to give under this clause what is the amount admissible, not what I am claiming. What is the amount admissible under this section has to be mentioned. If there is a dispute between the admissibility of a certain expenses being claimed by the assessee in the profit and loss account and in the audit, in the opinion of the auditor, then a proper disclosure may be required under this section also. Then clause 20b. This requires details of contributions received from employees for various funds as referred to in section 36(1)(5)(a), section 224(10). Now, what has to be reported is the nature of fund, that is whether it is ESI, whether it is PF. Some received from employees, what is the amount which was deducted from employee's salary. Due date, when the amount was payable as under the dates of those respective acts. Actual amount paid and the actual date of payment. This is a factual statement which we have to provide in this clause 30b. Now, what is happening at CPC in last 1 year, though there are numbers of decisions of various high courts which say if the contribution received from employees, though paid later on the due date as prescribed in the respective act, has been paid within the due date of the return filing under 139(1), the same has to be allowed. It cannot be added. But ignoring those decisions, the CPC is left and right adding the employees' amount received. If paid to the government, even if 1 day delay, suppose it was to be paid by 15th April and you pay on 16th April, then this was to be disallowed. Actually, what was the whole section of this scheme? Section 224 said the amount received from employees would be an income. Okay. In first instance, it became an income. Then section 36(1)(7)(5)(a) prescribed that any amount paid to the government within the due date prescribed in the respective VAT will be allowed. So the government was saying that because the amount received was per se income, amount has been paid late and so disallowed. High courts read in 43b. 43b is a non-obstante clause. It starts with notwithstanding anything contained in the act. Such expenses will be allowed on payment basis. And following that 43b, the high courts have held that these payments, even if paid late, then the date as prescribed in those acts, but before the date of 139(1) due date of return, it will be allowed under section 43b. But this clause requires a factual declaration. Whether if it is late or not, whether it will be disallowed or not, it is not the concern of auditor. He has to simply mention the amounts, due date of payment as per the respective act and actual date of payment. And full stop. What happens later on with the CPC, how the process is, whether we have to go for 124, then appeals or whatever, that is a separate thing. But here we have to give the factual statement. Then clause 21 requires amounts debited to P&L account being expenditure of capital nature. Yes, if any capital expenditure has been debited to profit and loss account, it has to be reported here. Though capital expenditure otherwise also should not be added to the profit and loss account because it is not permitted in the accounting standard. And if it is so, then we have to qualify that the account is not showing true and fair view, depending on the materiality of the amount of capital nature which has been debited to the profit and loss account. Expenditure of personal nature. If something is very clear, it is a personal expenses, it has to be reported here. But 99.99% the expenses are not. Suppose a car is being maintained by the SSC and the logbook has not been maintained. So how an auditor can judge the what is the amount of personal nature? We can't. So we will have to give a qualification, rather observations in para 5 of 3CD, that we cannot assess the instances of personal nature for these reasons. Or in case of the companies, if a car is maintained, then it is not the personal nature, it is the expenses of the company only. So expenditure of personal nature, if very clear that there are personal nature, then they should be mentioned here. But otherwise also, expenditure of personal nature should not be debited to the profit and loss account if we are certifying true and fairness of the business transactions. Then penalty or fine for violation of law has to be reported. Mind it, very specifically, penalty or fine for violation of law has to be reported. Not all penalties have to be reported. Not all penalties. If it is a penalty for violation of law, it has to be reported. Suppose you park your car and you are challaned and pay 1,000 fine, it is to be reported because it is penalty for violation of a law. But suppose you have entered into with the government for a construction of a road within a certain period, and you are not able to complete the road for a certain period, and in the nomenclature of the contract they impose 2 lakh rupees penalty for late completion of the construction or the project, then this 2 lakh rupees penalty is not for violation of law. It may have been imposed by the state government or anybody, but not for violation of law. This is all violation of contractual obligations. And any penalty, simply being named a penalty, will not become penalty unless it is for a violation of law. We have to differentiate between the penalty and compensatory nature. These two things are very, very important. Even if in the act certain word has been used that the penalty is there for this amount, it may not be penalty if it is of a compensatory nature. If interest is charged under a certain act for late payment or late filing of a return, then interest is a compensatory in nature, and it is not a penalty for violation of law. It is a violation of law, but not a penal nature. It is a compensatory in nature, and anything which is compensatory in nature will not be covered under this clause. Will not be covered, and for this you should refer the two very good decisions of Supreme Court, Prakash Cotton Mills Private Limited 201 ITR 684 and Swadeshi Cotton Mills 233 ITR 199, with a very clearly differentiated between the compensatory nature of the violation of law and the penalty. Penalty is disallowable, but a compensatory nature is not disallowable. It may be for a violation of law. Suppose the GST is to be paid by 20th of next month and I don't pay GST, I pay on 30th. Then naturally I have violated a law. But the interest which I have paid is not a penal nature, it is a compensatory nature, and so has not to be reported. Then last is expenditure incurred for any purpose which is offense or which is prohibited by law. Like if you give a goose to any officer of the state government, it is not allowable. It has to be reported here. Because it is offense to give a bribe to any government officer. So it is not to be reported here. And but again, mind it, expenditure incurred for any purpose which is offense or which is prohibited by law. Not everything. Again, a compensatory nature has to be admitted, but saying paying a bribe cannot be of any nature. It is an offense which is prohibited by law. Then we come to clause 21. Amounts inadmissible for non-deduction of TDS. This is simple. It is clear that if the amount of TDS is liable to be deducted, you have to, and not deducted, then you have to report it here. because it has become non-admissible under section 40A for not detecting TDS. In case of any dispute regarding whether the TDS is deductible or not deductible, and the SSE has taken a certain stance, and you are, or as an auditor, you are taking some different stance, you may give your observations in the case of this dispute, that this is the true opinion, and I, as an auditor, I have followed this particular opinion. Then section 40B and BA, interest, salary, etc. to partners disallowable. If anything is disallowable under 40B or BA, then it has to be mentioned here. It is disallowable if the salary to the partners is beyond the limits prescribed in the section 40B, or if the salary has not been given as prescribed in the deed of partnership. Now, previously there were certain disputes, and then the one thing was settled down, that if a calculation formula is given itself in the deed, it would amount to that you have specified the method of calculating deed, and that would be sufficient. But later on, certain cases have come of the High Court which say, even if in the deed of partnership it is only mentioned that the salary can be given in terms of section 40B of the Income Tax Act, or the various amendments in 40B from time to time, even then it would be sufficient and to be held that the salary has been given in terms of the deed of partnership. But the overall limit of allowability under section 40B has to be seen to claim the partner's salary. And if it is paid more, then it has become disallowable, which has to be reported here. Disallowable under section 40A3 and deemed income under 40A3A. They are two different things, mind it. Amount disallowable under section 40A3 is the amount of 10,000 rupees or more paid in a single day to one person for expense is disallowable. Any payment made to one person in a one day more than 10,000 expenses, it is disallowable. That is clear to all of us. But we somehow missed the second portion, that is, and deemed income under section 40A3A. Now, 40A3A prescribes what? Say, we are auditing 1920, and in 1819, we got purchases from one party, say for 25,000 rupees, and we debited purchases 25,000 rupees and credited to the party Mr. A 25,000 rupees in March 19. Now, in 1920, I made the payment to that party 20,000 rupees in one go in cash. So now, because the expenses was claimed in last year, the same cannot be disallowed this year. So they inserted the section 40A3A that in such situation, that amount which has been paid in cash against the amount which has been already claimed as expenses in last year's will be deemed to be income under the current year. And hence, it has to be reported here. So we have to report the cash payment of expenses of the year also, and paid to the parties of last year also if they paid more than 10,000 rupees, in case those amounts were claimed as an expense in the profit loss account in any of the past years. Then it will become deemed income for the current year. Provision for gratuity 40A7, that has to be reported. If gratuity payment has been, provision has been made in the books of accounts for the gratuity, then it has to be reported. Liability of contingent nature have to be reported. If it is a liability of contingent nature, naturally, if it is provided in the books of account, if the liability is there but has not been made provision in the books of account, then nothing is to be reported because it has not been claimed. Now, if a contingent liability has been claimed in the profit and loss account, then it has to be reported. Now, this itself can be a big issue of dispute, when it is contingent, when it is not contingent, when it has accrued, and things like that. But that will depend on a case-to-case basis of each transaction. Then clause 21H, it is regarding section 14A. One of the most litigated section in the Income Tax Act is 14A, which says this clause requires the amount of inadmissible expenses depends upon the facts and circumstances of the case. The rule now 14A is applicable when a SSC has invested into certain assets which income is tax-free income, like they have assessed and they have invested into shares which were earlier till last year their income of dividend was non-taxable. So then this clause was getting applicable on the basis that how much is the amount which has to be disallowed on account of the income which has been earned, which is tax-free. Because you might have earned certain expenses, you might have incurred certain expenses on earning those tax-free income. Though now in the current year, the dividend etc. is becoming taxable, so those issues might not be there in the current year, but still this section is very dicey section. Now this section governs Rule 8D, provides Rule 8D, which provides the method of calculating the amount which is inadmissible under section 14A. Rule 8D does not mandate that SSE should necessarily compute the disallowance as per Rule 8D2. The auditor will have to verify the amount of inadmissible expenses as determined by the SSE. SSE has to first determine the expenses disallowable, and on that basis, the auditor has to have its own opinion whether the calculation done by the SSE is okay. If it is okay, then fine, you give in this section. If you are having certain difference opinion, then you have to qualify your report and even do observations in the para 5 of the 3CD. This I have discussed. If in agreement with the computation by the SSE, report amount with suitable disclosure of material assumptions. If not in agreement, either give qualified opinion, adverse opinion, or disclaimer opinion, whether neither basis supporting document provided. Now, clause 22. This clause requires interest inadmissible under section 23 of the MSME Development Act 2006. Now, MSME Development Act 2006 section 23 prescribes if the person is making the payment late beyond a certain date, beyond a certain period to MSME, then he has to pay a certain interest to MSME. But section 23 provides further that this interest paid will not be allowed in the Income Tax Act. And though this disallowance is not in the Income Tax Act, this allowance is governed by the MSME Development Act. But this reporting is required if the SSE has made any payment to MSME for late payment of his dues. If no interest has been paid to MSME for late payment of dues, then this disclosure is not required, it becomes zero. But the problem is they are different. Suppose you say, कि साहब MSME, we have not paid any interest to MSME, though we have the credit balances of MSME, then okay, this clause becomes useless and it will become nil. But we are certifying true and fairness of the profit and loss account also. If an interest is liable to be paid under an act and we have not made a provision of the interest in the books of accounts, then depending on the materiality, whether the profit and loss account can be said to be true and fair. I don't think so. If it is a material amount, then we might have to qualify it in our true and fairness that the provision of so and so amount relating to interest being payable to MSME under section so and so of the MSME Act has not been provided for. And this will become appropriate qualification. In this clause, it will be definitely nil because we have not made any payment to MSME under section 23 of the MSME Development Act. Then this has been discussed. Then clause 23, 24, and 26. Clause 23, payments made to specified persons, 48(2)(b). This is very clear. They are having a list of the related persons, specified person, not related person, specified persons who have been defined in 48(2)(b), and if we have made any payment to them, generally payment made to them relating to the profit loss account have to be reported. If we have made payment to them against their loan account, it has not to be reported under these clauses. They have to be reported under a different clause, not here. Here we have to make reporting of the payment made to such specified persons, which payment are governed by the profit and loss account. Now, clause 24, amounts deemed to be profit and gains under section 32AC, 32AD, 33AB, ABA, AC. These are sections in which the special deductions are allowed, but special deductions are taken back if certain conditions are not met. If those are the things are there, then we have to report in this clause. Then clause 26, we have to report 43B. What are the taxes which have been accrued and not paid? And that list we have to report. This section is very clear. We have been reporting it for years, and we have to report only the taxes which are taxes hai, interest to the banks hai, and all these things have to be reported if not paid as on 31st March. Even if paid later on within the specified dates, but reporting has to be done. Clause 25. This is important. Amount of profit chargeable to tax under section 41 and computation thereof. Now, what is the amount chargeable under section 41? It says if liability which has been claimed as expenditure earlier and, mind it, and written back is to be reported. If you have made certain purchases, say 3 years back or 4 years back for certain party, and its expenses was claimed and the party credit balance is running, and you are not liable to pay now for any dispute or whatever reason, and you have written back that amount, then it is chargeable under section 41, not otherwise. If any amount has been written back which has not been claimed as in profit and loss account in the past, it is not chargeable to tax under section 41. Suppose a term loan is taken, and with the settlement from the bank, certain portion of term loan is not repayable, and you write it back, then that term loan written back is not amount chargeable to tax under section 41 and has not to be reported here. Only those portions have to be reported which are chargeable under section 41, and that is only if it is claimed as expenditure earlier and written back this year. Simply say many times happen during assessment that the AO was saying, sir, these credit balances are lying from last 5 years, you are not paying, so I will treat it as income under section 41. No, he can't. Because I have not written back in the books of accounts, he cannot treat it as an income. But that is a different issue, what happens practically. To be reported even if accounted for as income in profit and loss account, because it says amount chargeable to tax under section 41. Whether you have credited to profit and loss account or not, that is not the issue. So you have to report even if credited to profit and loss account. But then in cascade, that should be specifically mentioned that this amount has been credited to the profit and loss account. Clause 27. Amount of central value added tax credit availed or utilized. This is now redundant because central value added tax credits are no more there. This was relating to excise and customs, so it is no more applicable. Practically not applicable, though legally it is, but it is practically not applicable. Then particulars of income or expenditure of prior period credited or debited to the profit loss account. Now, what is prior period has to be seen in reference to AS5 and not otherwise. Any expenditure relating to earlier year may not be a prior year expenses if it is accrued this year. If an expense was accrued in prior year and related to prior year, then only it will be prior year. Or if there is a mistake, as AS5 says, if it is an error or omission, then it will become prior year. If it is not because of error or omission, then it will not be prior year expenses. For example, I make a provision for power bill, and I apply a normal logic of how much is the bills coming in the previous month and things like that, and I make an appropriate disclosure, appropriate provision of power bill, say 10,000 rupees. Next year, the bill came for 10,500 rupees. Now, this 500 rupees is not of the prior year expenses, because it is not on account of the error or omission in the accounts. It is because of change in the estimation, a logical estimation. So that will not amount to prior year. There may be many times when the expenses are relating to prior year, but they might have accrued this year. There might be certain cases going on against us in the civil courts by various suppliers or anybody, and the case might have been finalized this very year that I have to pay 10,000 rupees to Mr. So and so. It may that 10,000 may relate to the year of 2010 or 11 or whatever, but when the decision of the court took place this year, then it becomes the expenses of this year, irrespective of the fact that this may relate to the earlier year. So we have to make a differentiation between the amount relating to earlier year and amount becoming prior year in the current year. So for this, the AS5 is the thing which has to be definitely gone through. Clause 28. Whether during the previous year the SSC has received any property being share of a company, not being a company in which public are substantially interested, without considering. But this section was applicable from 1/6/2010 to 1/4/2017. So now in the current year, this clause is no more practically effective. Clause 29, applicable to companies only, mind it. It is not applicable to LLPs, to firm, partnership or individuals. Whether during the previous year the SSC received any consideration for issue of shares which exceed the fair market value of the share. Suppose you have issued the share on a premium. Then this clause gets applicable. If yes, please furnish the details of the same. And for valuation, whether you have issued the shares on the fair market value, you have to fall back on Rule 11U and 11UA, which are applicable in this case to work out the fair market value of the shares issued. And if they have been issued in value excess than the fair market value, then that has to be reported here. Then clause 29A, this was introduced on 20th August 2018. That's the last year. Whether any amount is to be included as income chargeable under the head income from other sources as referred to in clause 9 of subsection 2 of section 56. That this section is regard to the various sections of receiving gifts and all that. If you have received certain things, then the amount whether covered under section 56(2), then it has to be reported. Otherwise, it has not to be reported. Now, again, one thing here I may say, if I am doing the audit of business transactions as per the books of accounts of the SSC, who is individual, then his personal transactions, if any, on this count also. Suppose he got a gift of 1 lakh rupees from one of his relatives. Then do we have to report it here? No, we don't have, because I'm not auditing his personal transactions. I am auditing the business transactions of the firm Mrs. So and so. That's why I was saying that when I am auditing in the first slide, I said that the name of SSC should be used, name of the business and not personal name of the proprietor. But in case any business asset is being received, then if this clause is hit, then this has to be reported. Money received as advance for transfer of capital asset if the money is forfeited. Suppose I entered into an agreement with a certain person to sell my residence and have taken 5 lakh rupees as advance, and the person with whom agreement was done has backed out from taking it, and the advance was forfeited by me. then that advance has to be reported. Again, if these were business transactions, part of the business transaction books of the SSE, not his personal transaction. But what is forfeiture? When it is called forfeiture, you have to refer to Bankura Municipality versus Lalji Raja and Sons, AIR 1953, very old case, but very relevant case to know when it is said to be a forfeiture. Then 29B. This also was introduced in 20th August 2018. Whether any amount is to be included as income chargeable under the head income from other sources as referred to in subclause 10 of clause 2 of section. Same thing which I referred earlier also, that was with regard to clause 9. This is with regard to clause 10. Then clause 30 is the details of any amount borrowed on hundi or any amount due thereon. If money was borrowed against hundi, then only it has to be reported, not otherwise. All loans are not to be reported here. Other loans which are not on hundi will have to be reported in clause 31 and not in clause 30. This is specifically for hundi only. Then clause 30A, whether primary adjustment to transfer price as referred to in subsection 1 of IPNA has been made during the previous year. And if it is, then it has to be reported. I am not going to the detail of transfer pricing, because the domestic transfer pricing has now become very generally not applicable, because this is applicable now only if the two entities are situated in two different tax zones. Suppose one entity is in Delhi and one entity is having SEZ, and then you are having a transaction with a related party, then only your domestic transfer pricing are hit, otherwise no. So, but 92 CE is for international domestic transactions. The detail of into this I am not going, because that is too long a discussion for today's time allowed. Then clause 30B. Whether the SSE has incurred expenditure during previous year by way of interest or similar nature exceeding 1 crore referred to in subsection 1 of section 94B, that is interest paid more than 1 crore to non-resident, has to be reported here. If it is more than 1 crore. If it is to a non-resident less than 1 crore, no reporting is required. If it is more than 1 crore but not to a non-resident, then also not required. Then clause 31. Particulars of each loan or deposit in an amount exceeding the limit specified in section 269 SS. We all know that 269 SS has a limit of 20,000 to receive in cash. And in case the amount is already running and it is having a balance of more than 20,000, then we cannot receive even 1 rupee in cash. So it has to be reported here. Particulars of each loan or deposit in an amount exceeding the limit specified, taken or accepted during the previous year. Limit is 20,000. Particulars of each specified sum in excess of limit. Now, specified sum has been defined, which says advance received as advance or otherwise in relation to transfer of a new property. If received in cash more than 2 lakh rupees, then it has to be reported here, not otherwise. Then 31BA and BC, particulars of each received in an amount exceeding the limit as specified in section 269 ST. That is, the limit is 2 lakh. In aggregate from a person in a day, or in respect of a single transaction, or in respect of a transaction relating to one event or occasion from a person during the previous year, where such receipt is otherwise than banking channel. If it is a cash, then naturally this has to be reported in 31BA. In aggregate, mind it, in aggregate from a person in a day, or in respect of a single transaction, or in respect of transaction relating to one event. Suppose you are cutting a cash memo for sale to a one person of more than 2 lakh, you are hit by this section. And you may have to report that you have exceeded the limit specified in section 269 ST in respect of these transactions. Then section 32, details of brought forward loss or depreciation allowance in the following manner to the extent available. There is a new change in this clause. all losses, allowances not allowed under section 115 BAA have to be reported here. There are certain losses which are not allowed to be carried forward under section B. If you are opting 115 BAA, they will have to be reported. If you are not opting this section, then this new change will not have any effect. It will become simply not applicable. Sorry, just a minute. Now, B, change in the shareholding of the company. Losses cannot be allowed, as you know that if there is beyond a certain percentage of change in the shareholding of the company, then the losses to that extent get lapsed in terms of section 79. So that if it is so, that has to be reported here. Speculation losses की details जो है वो भी इस section में has to be reported. Clause 33 and 34. Section-wise detail of deductions, if any, admissible under section 6A or chapter 3, section 10 and all that have to be reported here. Now here only those have to be reported which are business deductions. If a man is paying LIP which is being debited to his capital account, though it is allowable under in chapter 6A under TC, but it is not to be reported here. We may give an observation that we are reporting in the case of individual the deductions which are covered part of the books of accounts of the business and not his personal accounts. Section 34, tedious deducted and paid details and detail of return filing and all. That is a long big chart which we otherwise also giving from last many years, and there is nothing important. This is only mathematical chart. How much is the tax deducted per month basis, how much is the tax due when you have paid and when you have filed the return, how much is the interest paid and all that. That chart has to be made out. Clause 35. In case of trading concern, quantitative details of minded principal items of goods traded. Principal items. The institute has opined that a principal item means an item which constitutes more than 10% of the total trading will become principal item, and that has to be reported. And you have to group the principal items together. Each and every principal item may not be required to be given separately. Suppose you are in ready-made garment, you may not have to say the shirts of 42 size, shirts of 35 size, 32 size, shirts of 44 size. No, you can say shirts. That is sufficient. So you have to define the principal items and the quantitative details of principal item of the good traded. 100% detail is not required for all the items being traded. In case of manufacturing concern, quantitative detail of principal items of raw material, again principal items, finished products and byproducts have to be given. In many situations, this information is not possible if there are multiple inputs and single output, or multiple single input, multiple outputs, multiple input, multiple outputs. So you cannot give the yields and all those things. There we have to give a comment that because of the nature of the manufacturing process and things like that, certain informations cannot be given for that limitation. Otherwise, we have to give information for the principal items of the raw material, finished products, and byproducts. Say clause 36 and 36A. In case of domestic company, details of tax on distributed profits under section 115. If you have declared dividends, then you have to give the details in this clause for the dividend distribution tax and all that. Whether the assessee has received any amount in the nature of a dividend as referred to in subclause E of clause 22 of section 2. This is regarding deemed dividend. This is also one of the most litigated section of the Income Tax Act. When an amount can be said to be a deemed income, deemed dividend, and when it cannot be said to be deemed income. And whether the assessee has received any amount in the nature of dividend. So it has to be mentioned if the assessee has received. Say if it is a company and company has made a payment to one of the directors, say 2 lakh rupees as a loan, it may become income in the hands of a director. Okay. But what here is to be reported? No, it has not to be reported here. Whether the SSC has received any amount, in that case, the SSC has made payment. The SSC has not received any amount, which can be said to be the dividend. In case the SSC has received any amount from a company in which he has invested the amount beyond a certain percentage and becomes liable for deemed dividend income, then this has to be reported here. Section 37 to 40, whether any audit was conducted under Cost Audit, Central Excise Act, Section 72 of the Finance Act, then you have to give a report. And if not, then no. For this also, you have to fall back on the management representation letter from the client, that whether any audit was conducted under these sections or not. Then clause 40, details regarding turnover, gross profit, etc. for the previous year and preceding previous year have to be given. The GP rate, NP rate, and stock turnover ratios and things like that. And 41 to 43. Again, this we have to fall back on the representation letter of the client. Details of demand raised or a refund issued during the previous year under any tax laws other than income tax. Mind it, we have not to report any refund or demand raised under the Income Tax Act in this. We have to refer it if it is demand raised or refund issued other than Income Tax Act, under tax laws. Not all the laws also, under tax laws. Then we have to be report here. Details to be furnished if required to be furnished apart form number 61 or so. Detailed transaction with international group, nothing. So members, this was my short presentation in the time permitted. I would like you to put any questions and I will try to answer out the questions if possible.
Yeah, members, those who have any questions can unmute themselves and turn on video and then say the question.
Yeah.
So meanwhile, I have a question.
Please.
So in clause 33 for chapter 6A, what we say that only in the business related deductions we should be writing.
Yeah.
So
actually we are auditing, like what is the theory? We are auditing the business transactions as per the books of accounts of the SSC. We are not auditing all the personal transactions of the SSC also. So we have to report as per the books of accounts. That's why it is better to limit our declarations as per the books of accounts. Hello.
Yes, sir. Right. And to be on a safer side, if we report the other deductions, there is nothing wrong, right, sir?
Yeah, nothing wrong.
If a single books of accounts here.
No, nothing wrong. Nothing wrong. But generally, I am giving the observation that the reporting under this clause is only with relation to the business transactions. In his personal transactions, it is not being covered. Because there might be a lot of situations when, suppose you have seen LIP from the capital account and reported it. He might have paid certain LIP from his saving bank account.
Okay.
And you have not seen the saving bank account while auditing, so you will leave it. Then it will be a problem in filing the return. Then the CPC will be saying that the auditor is saying so and so LIP deduction, and you are claiming so and so. So why the access should not be disallowed? Or you take the charge that all his accounts and everything are seen and then reported in total LIP and everything. That's why. That was the only reason for saying so.
Okay, thanks, man. Yeah. Anyone else with any questions? Okay, I believe in your presentation you have covered all the areas where people could have doubts. So So thank you for the fantastic session, sir.
See, what is said primarily, if there is no question, then either the presentation was totally useless, nobody understood anything, or everybody was so intelligent that they don't require it. Doesn't matter, but lighter way. In lighter
Right,
way.
sir.
Excuse me. Hello.
Yeah.
Am I audible?
Yeah, sure.
Yeah, sir, I had a small question. You said that we need not report on SENVETs, but we should report the SENVET taken on GSTs, right? The
It is not
credit
SENVAT.
availed.
GST is not SENVAT, it is ITC. They are saying the central
But
value added tax. Central value added tax is no more there. Central value added tax was a specific thing in the excise duty. It is no more in GST. GST it is ITC.
yeah,
It is not
sir.
central
So
value added tax.
okay, sir. Understood.
Uh-huh.
Okay, sir. Thank you so much.
Hello.
Yeah.
145A is redundant now.
Practically, yes. Practically, yes.
So no GST implication should be
No,
included.
it will not have any effect. It will not have any effect.
No, and no GST figures.
You read the institute's guidance note, even when the excise duty was there, it was not having any effect. It is such a long item, running into 7 to 8 pages in guidance note.
Yeah.
So they have given all the working also how to be calculated and things like that, and ultimately it comes out that it is not profit neutral, even in that period.
So if it was profit neutral also, the auditors required some statement in a particular format.
It was being mentioned. It was being mentioned, but it was not having any effect at all.
Now, no GST related figures are given. Thank you, sir. Excellent.
Hello.
Hello.
Yeah.
Yeah. So thank you so much for the wonderful session, Ashok sir.
Thank you.
And for your valuable time.
My pleasure.
Yeah, thank you. Thank you all members for being there. And for a formal vote, well-deserved vote of thanks, I would request C.A. Sakina Imani to present a very well-deserved vote of thanks to sir the session.
Thank you so much, sir. I would like to thank you on behalf of Baikala CPE Circle and the participants for such a well detailed explanation on each and every clause. You started with right from the communication with the previous auditor, which mostly people in small audits avoid, and you made us go through the importance of each and every clause in very detailed manner. Thank you for sparing your time, sir, and we would love to hear from you again when any such topic relevant to your area and scope of work comes. Thank you for your valuable time on behalf of the complete circle, sir. Thank you so much.
Thank you all. Thank you.
Thank you. Thank you, sir.
Thank you, sir. Excellent.